Welcome, good morning. Thanks for joining us. I'm Anil Kashyap from the University of Chicago, and I'm thrilled to be moderating this session. I want to start by thanking Laura Starks for including it on the program. Lots of people think that climate change is one of the top issues, maybe the top issue that will dominate global policy discussions over the next 50 years. And the implications of climate change touch all aspects of society. Today, we're here to talk about how it might interact with the financial system, and we have three experts to help us in this conversation. The plan is that we will do a round of initial presentations of about 25 minutes each. Then we'll have some follow-up questions and discussions amongst the panelists, and I'll leave plenty of time for questions. You should put your questions into the Q&A function that you can see on the webinar, and we'll go ahead and put them in as they come up, and we'll get to as many as we can at the end of the session. Our panelists are sufficiently prominent that I don't think they're going to need much introduction, but I'll say a little bit about each of them when the time comes. And the order of the presentations will be Isabel, then Carolyn, then Bob. So without further ado, let's get started. Isabel Schnabel is going to speak first, focusing on what central banks are doing in this space. She's currently a member of the executive board of the European Central Bank, and prior to that had a distinguished academic career, having served on the faculty at both Bonn and Mainz. And she also did a stint on the Council of Economic Experts for Germany. So Isabel, the floor is yours, and please go ahead and start sharing your screen.
Thank you very much, Anil, for the invitation to this excellent panel and for the kind introduction. So I'm going to talk about monetary policy and the green transition. And as you know, in 2021, the global economy was shaken by a major energy crisis. The prices for oil, gas, and electricity surged as our economies reopened after the shutdowns imposed in response to the coronavirus outbreak. And although last year's events were extraordinary on many levels, spikes in energy prices are a common phenomenon. Since the 1970s, sharp movements in energy prices have been a recurring source of economic dislocations and volatility. And yet, the roots of today's shock are likely to go deeper. While in the past, energy prices often fell as quickly as they rose, the need to step up the fight against climate change may imply that fossil fuel prices will now not only have to stay elevated, but even have to keep rising if we are to meet the goals of the Paris Climate Agreement. And in my remarks today, I will discuss the challenges that such prospects pose to both fiscal and monetary policy makers in an environment in which the supply of cheaper and greener sources of energy will only gradually be able to meet rapidly rising demand. I will argue that governments will need to push the energy transition forward, while at the same time protecting the most vulnerable members of society from energy poverty. And central banks, in turn, will have to assess whether the green transition poses risks to price stability and to which extent deviations from their inflation target due to a rise in the contribution from energy to headline inflation are tolerable and consistent with their price stability mandates. And I will explain that there are, in fact, instances in which central banks will need to break with the prevailing consensus that monetary policy should look through rising energy prices so as to secure price stability over the medium term. The world will have to undergo far-reaching transformation in order to be able to live up to the Paris Agreement to limit the increase in the global average temperature to 1.5 degrees Celsius above pre-industrial levels. At the heart of these efforts is the need to radically cut greenhouse gas emissions. According to the United Nations, global emissions would need to drop by 7.6% each year between 2020 and 2030 to reach the Paris target. By way of comparison, in 2020, when global economic activity came to a virtual standstill, emissions fell by only 5.8%. There is broad agreement that meeting these ambitious targets requires putting a global price on carbon, and it requires to do so swiftly. At present, only 21.5% of global emissions are covered by carbon pricing instruments, and only 4% are covered by a price of more than $40. According to a recent survey, most climate economists think the price of carbon should be above $75 to reach net zero emissions by 2050. The median response of $100 is consistent with what Nick Stern and Joe Stiglitz recently estimated to be the carbon price in 2030 necessary to achieve the goals of the Paris Agreement. In the EU, prices under the emissions trading system, the ETS, have recently started to rapidly approach these levels. So this is the blue line in the graph, in part reflecting expectations that the EU is committed to delivering on the clean energy transition. In early December, ETS prices reached a new record high of nearly 90 euros per ton of carbon, almost 3 times as high as at the beginning of 2021, and a multiple of their level a few years ago. The measurable rise of carbon prices will help accelerate the green transition. If persistent, it strongly disincentivizes new investments in fossil fuel energy carriers. And 2 parallel developments are reinforcing the effects of a higher carbon price. One is the European Commission's Fit for 55 package, which is an ambitious set of reform proposals which was presented in July last year. It includes a recommendation to significantly strengthen the ETS and widen its scope, which currently covers only around 40% of the EU's greenhouse gas emissions. The Fit for 55 package also proposes a review of the EU Energy Taxation Directive with the aim of raising the minimum tax rate for inefficient and polluting fuels and lowering those for efficient and clean fuels. The second development is the ongoing transformation in financial markets. Sustainable investment is no longer a nice-to-have policy, but it has become an essential ingredient in most investor portfolios. Many institutional investors have started to materially reduce their exposures to fossil fuel energy producers and have redirected capital to more environmental acceptable low carbon alternatives. ECB analysis shows that financial markets are increasingly serving as a corrective device. It finds that market prices have started to reflect the premium demanded by investors for exposures to climate-related risks. There is, in fact, a positive relationship between the greenhouse gas emissions resulting from a firm's operations and credit risk estimates as measured by credit ratings and market-implied distance to default. The magnitude of the effect is economically relevant. So this is the blue bar, which is on average comparable to that of traditional determinants of credit ratings, such as leverage, and that is the red bar in the graph. The analysis also finds that disclosing emissions and emission reduction targets helps lower credit risk premia. These are the yellow bars. Since financial markets are global, these developments seem to have started to produce tangible climate-related effects even in countries that do not yet have a national carbon price, such as the United States. So as you can see on the left-hand side, last year's strong economic expansion was characterized by an atypically slow response of US shale oil production to rising oil prices. As such, investments may no longer prove profitable to investors over the medium term, at least not to the same extent as they have done in the past, or as returns may have become even more volatile. In other words, even in the absence of a global carbon price, which clearly remains essential, there are growing signs that the green transition is accelerating around the globe. While such relative price changes are desirable and intended, they may weigh on the economy if firms and households cannot substitute more expensive carbon-intensive energy with greener and cheaper alternatives. Higher carbon prices work in part by stimulating investments and innovation in low-carbon technologies. But these investments will take time. At present, renewable energy has not yet proven sufficiently scalable to meet rapidly rising demand. In the EU, Renewable energies currently account for only around 20% of energy consumption. The Fit for 55 package proposes increasing this share in the EU to 40% by 2030. The combination of insufficient production capacity of renewable energies in the short run, subdued investments in fossil fuels, and rising carbon prices means that we risk facing a possibly protracted transition period during which the energy bill will be rising. Gas prices are a case in point. Last year's adverse weather conditions, which constrained the production of renewable energy, have led to significant demand and supply imbalances in the gas market as global growth accelerated, pushing gas prices to new record highs. So this is the red line. The green transition may reinforce these imbalances in the future. In many countries, especially in Asia, but also in the euro area, gas, which is half as polluting as coal, is seen as a stopgap solution in the secular shift to a greener energy system. In the EU, rising gas prices have a direct and immediate impact on wholesale electricity prices, which are linked to the short-run marginal costs of gas-fired power plants. In November, wholesale electricity prices in the euro area, so this is the blue line, reached 196 euros per megawatt hour, nearly 4 times as much as the average in the 2 years preceding the outbreak of the pandemic. And as a result, energy price inflation in the euro area, as measured by the energy sub-index of the Harmonized Index of Consumer Prices, the HICP, reached a historical high in November last year, with electricity and gas jointly accounting for more than a third of the total increase, also a new historical high. Energy, in turn, has been the prime factor behind the sharp rise in overall consumer price inflation in the euro area, with the HICP standing at 5% in December 2021, according to Eurostat's flash estimate, which was the highest level recorded since the euro was introduced in 1999. Between April and December 2021, energy contributed on average more than 50% to HICP inflation. And these developments pose significant challenges to policymakers, both governments and central banks. On the fiscal side, many governments have responded to rising energy prices by imposing tax cuts, price caps, or rebates to shield the most vulnerable households from the sharp rise in gas, fuel, and electricity prices. Because energy expenditures are typically highly inelastic and constitute a particularly large share of income for less well-off households, carbon taxes tend to be regressive. Already in 2020, 8% of the population in the European Union, or around 36 million people, said they were unable to keep their home adequately warm. Energy poverty is a serious threat to the cohesion of our society and to the support for climate-related policies. Compensation measures are therefore important, but such measures need to be designed in a way that does not reduce the incentives to lower carbon emissions. It would be a serious mistake if governments, faced with rising energy prices, would backtrack from their commitment to reduce emissions. Governments should also not slow down the pace of the transition or delay the phasing out of fossil fuel subsidies. 2 recent proposals by the European Commission go in the right direction. One is the introduction of a social climate fund, which aims to address the social impact of higher energy prices resulting from the proposed broadening of the scope of the ETS towards the building and transport sectors, both of which will affect households in particular. The other is a proposed system for EU countries to jointly procure strategic reserves of gas that can be released in the event of supply shortages. At present, capacity utilization of gas storage facilities in Europe is just under 2/3, almost 20% below seasonal norms. Energy buffers will help limit the volatility of gas prices. For central banks, the challenges are equally profound. In the past, central banks have typically looked through energy shocks for good reasons. Most of the time, such shocks were short-lived, meaning that a policy response would have amplified the negative effect of rising energy prices on aggregate demand and output, and given the long lags in policy transmission, exerted downward pressure on inflation at a time when the shock is likely to have already faded. Temporary supply-side shocks therefore typically warrant a deviation from the target in the short run, provided price stability is restored over the medium term and inflation expectations remain anchored. This insight also motivates our policy response today. In our baseline scenario, shown in blue, the current energy shock is expected to fade over our projection horizon. The Eurosystem staff projections are based on gas and oil futures prices, which suggest that energy prices should decline measurably this year, thereby significantly contributing to the projected decline in HICP headline inflation over the medium term. Such technical assumptions, however, are surrounded by significant uncertainty. In the past, futures prices have often significantly under or overpredicted energy price inflation, and these risks are arguably even larger today. And to see this, it is enough to look at the profile of the projected inflation path. The decline of headline inflation to levels below 2% at the end of our projection horizon hinges on the assumption derived from the futures curves that in 2023 and 2024, energy is not expected to contribute to headline inflation. History suggests that such a profile would be unusual. Since 1999, energy has contributed on average 0.3 percentage points to annual headline inflation. Sensitivity analysis conducted by Eurosystem staff suggests that it is enough for oil prices to remain at November 2021 levels for HICP inflation in 2024 to reach our target, which is the yellow line. The scale of the energy transition and the political determination behind it implies that these estimates could be conservative. Potentially protracted supply and demand imbalances related to transition fuels such as gas, as well as the fact that carbon prices are likely to rise further and to extend to more economic sectors, mean that the contribution of energy and electricity prices to consumer price inflation could be above rather than below its historical norm in the medium term. The energy transition therefore poses measurable upside risks to our baseline projection of inflation over the medium term. At our Governing Council meeting in December, such risks were one factor in deciding on a step-by-step reduction in the pace of asset purchases over the coming quarters. The pace of adjustment with net asset purchases under our asset purchase program, APP, falling back to 20 billion euros in October is consistent with what Alan Greenspan previously called a risk management approach to monetary policy. It prescribes that central banks should not only consider the most likely future path of the economy, but the entire distribution of risks around that path with a view to keeping sufficient optionality to address all inflation contingencies. So the question then is, if energy inflation were to prove more persistent than currently anticipated under our baseline scenario, at what point could we no longer afford to look through such a shock? And I see two scenarios where monetary policy would need to change course. The first would occur if we were to detect signs that inflation expectations have become de-anchored. Consumer price expectations are particularly susceptible to changes in the prices of goods that we purchase frequently. Energy and petrol in particular are part of this basket of goods. Over the past year, consumer price expectations for the next 12 months have increased sharply. In October, when energy accounted for more than half of the rise in measured inflation, they reached the highest level since the euro was introduced and have remained close to record highs since then. The experience of the 1970s, when rising energy prices triggered a harmful price-wage spiral, emphatically demonstrated that allowing inflation expectations to drift away from the target makes it significantly costlier to bring inflation back to target, both in terms of lost output and higher unemployment. So far, however, there are no signs of broader second-round effects. Wage growth and demands by unions remain comparatively moderate. But in an environment of large excess savings and protracted supply disruptions, the energy transition may lead to inflation remaining higher for longer, thereby potentially raising the risks of inflation expectations destabilizing. And in this case, monetary policy would need to respond to, rather than look through, higher inflation to preserve price stability over the medium term. The other scenario in which policy would require adjustment is if the nature of the shock were to change. More than a decade ago, the seminal paper by Lutz Kilian established that not all oil price shocks are alike. The effects on the economy critically depend on the underlying source of the shock. Rising oil prices due to stronger aggregate demand, for example, are associated with an increase in real economic activity, calling for a different monetary policy response than if oil prices were to rise in response to supply disruptions in the oil market. A carbon tax may share some of the characteristics of an adverse supply shock. Higher energy prices could weigh on economic activity and thereby put downward pressure on consumer price inflation in the medium term. In this case, monetary policy should look through temporary deviations of inflation from its target. But a carbon tax differs from an adverse oil supply shock in two fundamental ways. One is that the transformation of our economies through large-scale public and private investment programs and the subsequent adoption of more efficient and greener technologies is expected to boost rather than weigh on economic growth and thereby support wages and aggregate demand. The second aspect is that for an energy importing economy such as the euro area, oil supply shocks are negative terms of trade shocks, raising inflation and transferring wealth abroad. But a carbon tax is ultimately a domestic levy that shifts financial resources from the private to the public sector. In the EU, for example, the coming years are expected to see significant increases in ETS revenues. ECB calculations based on data from the European Commission suggest that they will rise from 14 billion euro in 2019 to up to 86 billion euros annually in the period 2026 to 2030. The proposed carbon border adjustment tax, which will put a carbon price on selected imports, as well as higher minimum tax rates on fossil fuels and other national tax initiatives, will further raise revenues. Eurosystem economists show, based on the example of Spain, that what governments would do with such revenues will shape the response of the economy to the energy transition. For example, lump sum transfers to households and electricity bill subsidies, as currently implemented by many governments, can largely cushion the negative short-term effects of rising energy prices on consumption and GDP. Alternatively, if revenues are used to cut other distorting taxes, such as social security contributions, thereby reducing the labor tax wedge, a carbon tax may in fact boost economic activity, even in the short term. And since new activity will likely arise in greener sectors, part of the increase in GDP will be permanent, potentially raising inflation both over the short and the medium term. And these findings are not just hypothetical. An emerging strand of empirical evidence finds no robust negative effects of carbon taxes on GDP growth and employment. If anything, the evidence is consistent with the modest positive impact. And as such, if the future path of energy prices threatens to push headline inflation above our target in the medium term, and if growth and demand prospects remain consistent with firm underlying price pressures, monetary policy needs to act to defend price stability. So let me conclude. Carbon prices in the EU and elsewhere increased sharply last year, reinforcing efforts to reduce carbon emissions as fast as possible and accelerating investments in green technologies. As the shift in the energy mix towards cheaper and less carbon-intensive fuels will take time, a rising carbon price, higher tax rates across a range of fossil fuels, and a relatively inelastic energy demand may lead to continuous upward pressure on consumer prices in the transition period. And I've argued that these developments pose challenges to both fiscal and monetary policy. So governments will have to protect the most vulnerable parts of society from higher energy prices in a way that does not delay the green transition. Monetary policy, for its part, cannot afford to look through energy price increases if they pose a risk to medium-term price stability. And this could be the case if prospects of persistently rising energy prices contribute to a de-anchoring of inflation expectations, or if underlying price pressures threaten to lift inflation above our 2% target, as rising carbon prices and the associated shifts in economic activity boost rather than suppress growth, employment, and aggregate demand over the medium term. So this is where I would like to stop. Thank you very much.
Okay, thank you, Isabel. A central banker, a deal is a deal. You said you'd take 25 minutes and you did just that. So thanks for staying on time and for those fantastic remarks. And we'll take some of that up in the conversation that follows. And I remind everybody, if you join late, you can put questions into the Q&A part of the webinar at any point. We'll pick those up at the end. Our next speaker is Carolyn Wilkins. Carolyn is another distinguished central banker. She's been a leader at the Bank of Canada for 20 years, culminating her career as the senior deputy governor. Prior to that, she worked for the finance ministry, and she is now at Princeton and is one of my colleagues on the Financial Policy Committee at the Bank of England. And she is going to talk a bit about international coordination efforts. So Carolyn, please go ahead and share your screen.
Well, thank you very much for that introduction, Anil, and also for the invitation. It's really a pleasure to participate in this panel. I thought that this was a really excellent start by Isabel talking about one of the core functions of central banking. And I thought that I would add to the discussion that we're going to have afterwards by making 3 points. And one is really how achieving our climate goal is really a global and multifaceted public policy problem that the private sector and the public sector has to confront. And second point is really how central banks and financial regulators take this fundamentally human and multifaceted problem and link it to our mandates is something that is the subject of a lot of discussion. And again, Isabel started us off with how we think about it in terms of monetary policy. What I thought I'd do is talk at a high level about one of the tools that's been deployed recently in the climate area as it pertains to the job of central banks and other financial regulators with respect to financial stability, and that's use of climate scenario analysis. Before I start, I just wanted to make it clear that these are my views and don't necessarily reflect the views of the Financial Policy Committee or other policy committees of the Bank of England. So if we start with the first point, that climate change is really a global multifaceted problem, I'd just like to direct you to some work that was done last year at the G7. And I think it's especially important because we have COVID on our heads, COVID and the COVID problem in our heads right now as being the most pressing problem. And I can see why that is given where infection rates are. But when we think about the most significant risks that are facing the financial system, that are facing society over the next few decades, they're unlikely to stem from just one shock, but probably from a combination of adverse events that are related to the environment, to health, and geopolitical tensions, socioeconomic stresses. And it's really for that reason that under the UK's presidency of the G7 last year, their prime minister decided to strike an independent panel on economic resilience, so the building back better. And I was fortunate enough to work with some fantastic people on that panel. Now, our mandate was to give advice on how the G7 could work together to build economic resilience. And there are 2 points here that I think are relevant to the discussion today. The first point is that climate is the single biggest intergenerational threat. But the policy challenges aren't all about climate. You could see it here in the 7 strategic policy areas that we chose, which included, aside from climate change and the environment, things like global health, digital governance, supply chains, labor standards, and you can read the rest. And I think that that's pretty important because when we have these multiple set of problems that need to be tackled at the same time as climate change in the environment, we can see just how difficult that's going to be and how the risks of something not being done correctly, start to grow. And I think that while there's a lot of work that's required at the domestic level, There's many of these aspects that just can't happen unless we're all rowing in the same direction at the global level. And our job was really to see, well, what could the G7 do together and show leadership in a way that would help push us individually along, but also help create that leadership at the global level to make the right things happen. And I've just added a selected recommendations where we thought the G7 could contribute. And I don't want to go and read through them all, but I've highlighted the ones in green that in fact may be under other categories, but in fact speak directly to what needs to be done in terms of climate change. And so it gets to my second point, that climate change recommendations that are self-reinforcing aren't necessarily only about the narrow view of climate change. And you know, one of the obvious examples here, Isabel already mentioned, which is investment. We know that we need an investment-focused recovery to achieve our economic and social objectives. And there's nowhere where this is clearer than on the green transition. If you look at OECD estimates of how much is needed, and they've got up to some 77 trillion US dollars in investment in things like transport and water and all the usual suspects, and that's per year until 2030, if we want to make just the 2% degree rise objective. And so that means that other parts of our recommendations, like minimum tax rate on corporations, that in fact the G7 did end up pushing along, are pretty important, because again, the OECD estimate that you can get perhaps up to $44 billion in tax revenue, and that goes at least part of the way to helping finance those investments. You know, supply chains only became a sexy topic recently when we think about inflation and you know, some of the empty shelves, but at the same time, they are essential to the transition, especially when you think about critical minerals, and the fact that these supply chains are fragile because they're dependent on parts of the world that have geopolitical tensions or poor labor standards, and this concentration risk doesn't meet our resilience objectives nor our objectives with respect to labor standards and participation. And so that's also a pretty important part. Now, I think what we can take from this is just that these interconnections make it an even more difficult problem for the public and private sectors to address. But they're critical, if nothing else, not only to succeeding, but to getting the social license that is required to make some of the hard choices. And I think it shows just the broad scope of the public policy challenges in general. Now, when you take it to, well, what do central banks and financial regulators have to do about this? Clearly, the perspective of central banks and financial regulators is going to be much, much more focused. It's kind of humbling, and I think that's why I wanted to present it as well. You know, the full range of things we need to think about, because you know, what central banks and financial regulators are going to be looking at are, well, what are the microprudential implications of climate change? What's the macro impact? What kind of things do we need to do from a macroprudential side, a system-wide financial risk side that relates to climate change, and how can we develop capabilities within our own institutions and within the institutions in the financial sector to manage these risks, either by reducing them or by being more resilient in the face of them. And so one of the reasons is just that central banks need to be, and financial regulators need to be very careful about keeping themselves true to their mandates, and whether it's monetary policy or regulation of financial institutions or financial stability. surveillance. Now, one of the tools that's being developed is called scenario analysis, and nowhere than the NGFS, so the Network for Greening the Financial System, is more work being done, and that's a consortium of central banks and regulators and others who are trying to perfect the art of climate scenarios and impact on the financial system. And the numbers on this chart that are below the particular objectives are just what I got this from Sarah Breeden's speech, but who many of you listening must know from the Bank of England. But basically, it's a survey that they did of why our central banks and other regulators working so hard on scenario analysis. And in many ways, I think this is familiar territory, in the sense that since the financial crisis that we had, in 2008, 2009, there's been a lot of work that's been done to develop stress testing models for financial institutions. And these stress tests have been used as input to assess issues that are related to capital adequacy or capital distribution. Now, the starting point for this analysis is usually the same. You kind of map out an analytical diagram of the transmission channels when for risks when they materialize. And the state of play today when it comes to climate risks is kind of the same. What the folks who are working on this have done, and if you look on the left side of this graph, is that they've kind of grouped climate risks in two groups, one related to the transition of moving towards a lower carbon economy, and the other is to physical developments that propagate through the world that are related to climate change. And of course, the transmission channels go through the usual suspects. There's businesses and households, there's the macro feedback loops that in turn end up on the plates of financial institutions, either through credit, market, liquidity, and other risks that are well known and loved. Now, the thing that Sarah said in her speech in November, which I thought was perfect, was she said, these are in neat little boxes, but she said it's fiendishly complex. And I think that's right. If you just think, for example, about transition risks and physical risks, they're not really in neat little boxes. At a minimum, physical risks are a function of the transition. The slower it is, the more likely physical risks are worse in that they grow over time. So that one little example that I gave is really just the tip of the iceberg when it comes to the complexity of trying to do these analyses. There are many complex issues that are below the surface that impact the quality of the results and their usefulness for policy analysis or risk management. And the first is that there is an unusual degree of heterogeneity with respect to the potential impact across assets and across geographies. And that's just a start. When you think about that heterogeneity, a really, I think, intuitive example is with respect to household property insurance or mortgages on houses, because it varies significantly by region. It can vary significantly even by neighborhood. And so trying to model that is extremely detailed. Now, climate risk can also vary by income and wealth bracket, which of course is important to understand when it comes to public policy and financial risks. And what we tend not to talk too much about is the fact that some asset classes, such as those related to green tech, may face upside risks. The second niggly problem is there is an extreme amount of interdependency between a wide range of factors that will ultimately drive what climate scenario is realized and how this is going to transmit to the financial system. And it's particularly difficult when we have pretty much no historical experience to draw on And it's not conducive to simple regression based on time series and things that, and calibrations that we've managed, however imperfect, to put into bank stress tests, for example. And I think third, and probably the most important, is the fact that there's extreme uncertainty with respect to how climate and the environment are going to evolve. And the NGFS worked with global experts on the climate in climate science, and these experts identified 60 potential scenarios to work with. It's fantastic, but even once you've done this, it's not very easy to assign a probability to them, or even say which are plausible. And I think it's also highly uncertain how policymakers and investments would behave in these changes. This aspect of human behavior is pretty difficult to predict. And unlike usual stress testing, again, here, there's no history. And, you know, I'm saying this, and it's clear to me when I read the documents and talk to the people who are working on this, that they're painfully aware of the horizon over which the scenarios are being run. I mean, they're 30 years to 100 years. And that's quite different from a bank stress test that usually is, you know, three to 5 years. And so, but nonetheless, they've forged on, and I think that's good. So what I've got here, just to show what kind of output you get from this, you can get from this. Let's just focus on the right-hand side of the slide, which is a chart that shows the initial estimates of costs of different scenarios with respect to GDP. And in here, what they focused on is loss from materialization of physical risks. One scenario, current policies are maintained, and the other, if actions taken to achieve 1.5 degree increase in temperature by 2050. So a timely action type of scenario. And what strikes me is that according to these estimates, taking action doesn't actually have to be that costly on average in GDP space if it's timely and sufficient. But doing nothing or keeping things the same as they are today could cost a lot. And this cost just only grows over the time. And by the end of the century, it's about 13% of GDP. And clearly there's a truckload of uncertainty around these estimates. That's why they've got those gray bands around it. Part of it is because of the uncertainty I talked about, but another part is that they don't include all the chronic and acute physical risks that one could think of. These estimates don't include effects from rising sea levels, for example, or potential changes in social factors such as migration. And on the migration side, that could be really important. The World Bank suggested that climate change could displace almost 140 million people by 2050 from countries in sub-Saharan Africa, Latin America, and Asia. Well, the NGFS folks are really aware of these, and for that reason, they have a work plan to improve these estimates. And they tell us, well, we should really look at these as an upper bound of the estimate. So it's likely to be a lot worse if we do nothing. If we look at the map on the left, we can see that the costs of doing nothing are borne unevenly across the globe. And one of the reasons that I talked about the integrated policy issues was because without the social part of it, whether it's labor, whether it's governance, there's just no way that we can look at this map without seeing that managing these other aspects that are humanitarian and socioeconomic have to be part of the plan, and the probability of that occurring needs to be factored in on which line, which scenario you think is most likely to occur.
Carolyn, there's a clarifying question. Are the numbers here flow per year or cumulative over the whatever 80 or 100 years?
I think they're cumulative, but that's what I assume, but I need to check.
Okay.
So the climate scenarios do produce a number of useful outputs, and I think that we have to keep sight of that. And they, if nothing else, focus the mind to inspire us to act. But if you look at it objectively, you know that there are still a lot of gaps that limit the ability to fully assess the macro financial risks and in that sense inform policy decisions or inform risk management decisions of individual countries. And so I thought I'd just end by outlining a couple areas that I think are worth digging into, and they're pretty consistent, I think, with what others have reported on as well. The first is really just comparability across exercises. There's lots of different models out there, different approaches, and so some sort of consistency would be useful, even though we know that we still need to tailor them for individual jurisdictions' needs. And so I think there's going to be no way to avoid actually developing common risk classification standards that these different model results can be mapped into. The second area is just really knowing that this is a stochastic rather than a deterministic problem. I mean, even if we knew that what the trajectory of the climate would be, the underlying outcomes are still a stochastic process. And so I really like the NGFS's plan to develop methods to calculate probabilistic losses and gains from climate impacts. And the third thing is really the completeness of the output for risk management. If you're a risk manager, GDP is great, but you're looking at your portfolio, you're looking at your business, and so we need a lot more granularity by sector. Again, back to my example of house level data for physical risks. I know out there in the private sector space, there's a lot of entrepreneurs working hard with financial institutions to do just that. And then finally, and I'm pretty sure I hand off to Bob, aside from having a lot of great policy recommendations in his report, I'm sure he's going to talk about the data. So I'll just say we need better data. My final thoughts are just a summary of what I think we should keep our minds on, which is that, this is a big intergenerational threat that we're facing, and it requires just massive multidimensional response. And central banks and financial regulators have a very focused mandate here, but it is a critical role to play, and it's particularly given that I think climate change is a real risk to the financial system. And there's been such a lot of good work that's been done on climate change analysis, but much more is needed if we want to increase the usefulness for policy and risk management. And here, given the audience, I just give a pitch to the academic crowd to say that we need your help with what are extremely complex technical issues.
All right, thank you, Carolyn, and thank you again for sticking to time. There's about 100 of you in the audience, at least right now, so I'm sure that there's plenty of questions. We've got one intrepid question that's been proposed, so start loading them up. But our last speaker will be Bob Litterman, and Bob wears many hats. Some of the current ones include being a partner at Kepos Capital, serving on the boards of Resources for the Future and the World Wildlife Fund, and chairing the CFTC's climate-related market risk subcommittee. Previously, he's also done many things, but had a long career at Goldman Sachs, including senior positions in research, risk management, and investments. So Bob, please go ahead. You can begin sharing now, and the floor is yours.
Thank you, Anil, and it's a real pleasure here to join this panel with Isabel and Carolyn. And I have basically two topics that I want to talk about. One is the Commodity Futures Trading Commission report that I chaired, and the report was written and delivered last year. And then secondly, I want to focus on something we call a carbon barometer that my firm Kepos has put together to measure comprehensive incentives to reduce emissions. And I'll talk about the diversity of those incentives globally. So this report that we put together last year, actually it started about over 2 years ago. And one might wonder why the Commodity Futures Trading Commission took the lead on this. And it's because, under the previous administration, I think the folks that you would expect, the Financial Stability Oversight Council and the Fed and the SEC, we're trying to avoid too much controversy. The CFTC is really focused on risk management. It manages the derivatives markets in the US, and they have a market risk subcommittee that was chaired by Commissioner Russ Benham, who had some hearings about 2 years ago on climate related risks. And the subcommittee, or the committee, the MRAC, the Market Risk Advisory Committee, decided to create this climate related advisory subcommittee from the private sector. And they asked me to chair that subcommittee. We published our report a little over a year ago, September 2020, and it was unanimously approved by the members of the commission. Of the subcommittee. Commissioner Benham had asked for a relatively high level 50-page consensus report with specific recommendations. I think we met those goals, except that in fact, rather than 50 pages, we ended up taking 165 pages. And we agreed on much more than expected, including 53 specific recommendations with supporting materials. So let me go into that in a little more detail. First of all, it was a very diverse group of financial market participants represented on the committee. We had asset owners, asset managers, banks, insurance companies, an exchange, a number of non-financial corporations, including oil companies, ag companies, data companies, and analytics companies. We had a number of academics and a number of environmental groups. So one of the things that confronted us was that unanimity was not going to be easy. When I started, I had no idea where we would run into issues and how they would be resolved, but I actually was quite surprised and gratified to find that it wasn't as hard as I might have thought. So what are some of the things that we focused on? Well, we had a really broad set of topics. Climate risks, this was a risk committee, so risk was at the center of our discussions. Data and analytics, very important when you're trying to understand risk. Also climate disclosure, what private organizations, public companies need to disclose in terms of climate related risks. The role of financial regulators, scenarios and stress tests, and then finally financing the net zero transition. So what did we agree on? Well, first of all, and this is a quote from the report, let's start with the need for appropriate incentives. Appropriate incentives are fundamental to the efficient allocation of capital. They're urgent, they're missing, and they need to be addressed. And that is particularly in the United States. Financial markets today are not pricing climate risk. Financial markets can do that on their own. If this fundamental flaw is fixed, capital will flow in the wrong direction. That's the context for, but not the focus of this report. And so recommendation 1 that you can see here is really fundamental. Just quoting it, the United States should establish a price on carbon. It must be fair, economy-wide, and effective in reducing emissions consistent with the Paris Agreement. This is the single most important step to manage climate risk and drive the appropriate allocation of capital. And on this topic, there really was no disagreement. Right from the beginning, everyone agreed. And perhaps it's not surprising because in some sense, appropriate incentives to reduce emissions is not a question, it's a tautology. It's true by the nature of the word appropriate. Of course we need appropriate. And so it's really only a question of what's appropriate. And that's something that we can come back to. But the report also reflected a number of other fundamental principles, in particular, the need for collaboration with international efforts to address climate-related financial market risk. And these are quotes again from the report. The need for leadership by the financial regulators to guide an iterative process forward while leaving room for American financial innovation. a consensus about the need to quickly improve the quality of data, analytics, and understanding of the many dimensions of climate risk. Approaches to scenario analysis, stress testing, and standardization of definitions that will help move us forward on what will no doubt be a complex, iterative path toward the development of meaningful disclosure of material climate risk information, a goal toward which we all agree we must move very quickly. So really a lot of consensus about where we're going, about the need for collaboration, about the role of the financial regulators, and so on. With that, let me now turn to the second topic I want to talk about, which are global incentives to reduce emissions. And this is really the most critical aspect of the climate response. And in managing climate-related risks, incentives are the only brake that we have. Incentives are really key. As an economist, this is what I focus on. And the risk is exploding over time. And so we need to slam on the brakes. Right now, we don't have those appropriate incentives. And when we think about incentives, as an economist, we're thinking not only about carbon taxes or cap and trade systems, but more comprehensively, what are the marginal incentives to reduce emissions? And this is something that governments haven't really focused on. And we found some surprises here. Now, the first thing is clearly the obvious thing, and we're looking at these comprehensive incentives over time, and they're much too low. Globally, what we're showing here are the globally averaged comprehensive marginal incentives to reduce emissions. And these include not just carbon taxes and cap and trade systems, but also, very importantly, fossil fuel taxes and subsidies. Those are, by the way, the biggest components of these incentives. Feed-in tariffs, low carbon fuel standards, and renewable portfolio standards. And we look at 25 different countries representing 82% of global emissions. We have data starting from 2008, and we just updated the numbers for 2020, I'm sorry. And then what you can see is these prices have really been, on average, very low. They just recently rose above $10 per ton about 5 years ago. And as of our most recent data, 2020, they're just below $20 per ton on average around the world. So now let's look at a little more detail about these incentives and the diversity across countries. We do not have harmonized incentives. In fact, one of the first things that strikes you is that European nations have very strong incentives to reduce emissions. And in fact, if you recall, I think it was Isabel who showed us a graph of the EU ETS prices just a year ago, that is in 2020, which is our most recent data. Those EU ETS prices were on the order of 32 euros per ton. Today, they're over 90 euros per ton. In fact, well, maybe not over 90. They were over 90 recently. I think they're about 85 euros per ton. It's almost $100 per ton in Europe as of this year. And they've been going up very rapidly. Now, when you combine those with fossil fuel subsidies and so on, what you find is that the fossil fuel taxes, which are very high in Europe, and you find that the average incentive to reduce emissions is well over $100 per ton in those countries. Now, if you look at the US and China, you see that we do not have material incentives to reduce emissions. And in many countries around the world, particularly in the Middle East, you have very strong incentives to subsidize and produce more, subsidize emissions and produce more pollution. So there is no harmonization. We need to get to appropriate incentives and harmonized incentives globally. Now, different countries use different approaches to climate policy, but what you see is that they all still have subsidies to emissions, and that the main incentives to reduce emissions are actually the gray bars, which it's perhaps hard to read these the scale here, but those are the fossil fuel taxes. So fossil fuel taxes are by far the most important component of these globally comprehensive incentives. In the United States, what we're talking about here are the gasoline taxes. Now, many people don't include those as incentives to reduce emissions because they were designed really to pay for road maintenance. But of course, if you're driving an electric vehicle, you don't pay these gasoline taxes. And so we consider them a marginal incentive facing consumers that will discourage the production of emissions, as are other fossil fuel taxes. But the clear message from these different incentives across different countries is that those fossil fuel taxes and subsidies, the subsidies are the yellow bars going in the wrong direction, are by far the largest component. When you look at renewable policies, you see them as kind of at the top of these bars. In some cases, feed-in tariffs are pretty important. For instance, in Germany and China, a little bit in the US, you have some renewable portfolio standards and so on, but they're very small. And then similarly, when you look at carbon prices, they represent a growing but currently very small component, even in Europe, of the overall incentives to reduce emissions. Those are the orange and dark bars at the bottom of the screen. So we're really only getting started globally when we're not harmonized. Now, the final thing I want to look at is the relationship between the price, the incentive that we create to reduce emissions, and the carbon intensity. And what you see here on this graph is the comprehensive carbon price across the horizontal axis, the carbon intensity on the vertical axis, and these are the large emitters, Europe, United States, and China. And the size of the circle represents the scale of the emissions. And so what you see here is that in Europe, where we have strong and growing incentives to reduce emissions, we have much less carbon intensity. It's just about 1/6 of a kilogram per dollar of GDP, whereas in the United States, where we don't have those strong incentives, and in China, the carbon intensity is higher. It's about 1/4 of a kilogram per dollar of GDP in the United States, and about 1/2 a kilogram in China. If we then go on and add the other countries around the world, we can see that Japan is next behind Europe. Russia is near China. India and the other Americas are near the United States. And in the Middle East, there are large fossil fuel subsidies. And you can see that there's kind of a direct relationship here between the strength of the incentives to reduce emissions and the carbon intensity, an inverse relationship. It's also true, although I didn't put a graph here, that if we look at the rate of decarbonization, it is very much also related to the strength of these incentives to reduce emissions. So with that, I'll stop here and we can move into the question and answer session.
Okay, thank you, Bob. That's quite interesting. And do you guys post your data on that carbon comprehensive carbon price?
Yes, it's out there, the methodology and the data and everything, on something called the Kepos carbon barometer. It's easy to find.
Okay, thank you. That's great to know. So there are lots of overlap and lots of points of commonality here where we can start. So let me go in reverse order, and any of you can jump in on any of these things. And again, to the audience, please use the Q&A function. We'll get to your questions in a bit. But first, let's pick up some of the obvious things. So for you, Bob, I think there were two things that struck me initially. One was the mere fact that you could get unanimity from that group to sign that thing is like a heroic act. I mean, maybe you're qualified for sainthood to pull that off. But I'm curious as to how you can get the oil companies to sign on if the idea is there's going to be a carbon tax. So can you say a little bit more about what the fossil fuel emitters say about how it is that your leading thing, which is we need to price carbon appropriately, jives with their worldview and their duty to their shareholders? So let's start with that.
Sure. Well, you raise a great question. And going into this, I had no idea, how hard it would be to get unanimity or where the issues would be. It turned out, I'll be honest with you, that there was not a lot of pushback from the oil companies. And I think it's not surprising in some sense. They recognize reality. Even the American Petroleum Institute today is saying that we need a market-based approach. So the pricing of emissions, I think the oil companies recognize on the one hand that it's not going to be good for their business, at least their historical business, but on the other hand, it's absolutely necessary. And this is the way to go, particularly if you were to contrast pricing versus regulation. And so I think the view of the oil companies, one of my hats that I wear is as the co-chair of the Climate Leadership as Council. And the oil companies have been big supporters of that. We're trying to get a bipartisan approach to pricing carbon in the United States. So at the first meeting of this subcommittee, I said, look, it seems to me we need to have a price on carbon. Does anyone disagree? And there was no disagreement. Now, we later came up with the wording of a recommendation, and there was some discussion around that. But that part wasn't hard. Another issue that I thought might be harder than it was the question of disclosure. So early on, there were members of the subcommittee who said we need mandatory disclosure of climate-related risk. And I asked the question, does anyone disagree with that? It turned out no one disagreed with that. And the key word wasn't mandatory, really. Some people thought that would be the issue. The issue is what is material. So it's been true, for a long time that you have to disclose material risks, public corporations do. But the really tough question in the context of climate is what are material risks? And that's something that the European regulators and the NGFS have been struggling with. And the real issue is because the time horizon is so different. As I think Isabel mentioned, we usually think about stress tests and capital adequacy over a relatively short horizon, maybe a business cycle at the maximum. And yet here with climate, we're talking about decades, if not longer, for these kinds of material risks to demonstrate themselves. And so how do we think about that? That's a really tough issue, and it requires scenario analysis and new ways of thinking. And I'm sure it's going to be iterative and something where we need to have public sector and private sector cooperation. I will finally say that where we really had some difficulty, and perhaps not surprisingly, was in issues like disclosure of scope 3 emissions. And we
Just
we had
define
some
scope 3 in case there's any non-experts here.
Yes, certainly. Well, the emissions can be divided up into those that you directly emit as a public company, your scope 1, the indirect emissions from your energy uses, such as the emissions from burning whatever fossil fuels to generate electricity that you use in your process. And then there's the supply chain emissions, so the indirect emissions. And for example, with oil companies, these include the emissions that come from the tailpipes of cars, from people driving. And who's responsible for those tailpipe emissions? Is it the driver of the car? Is it the automobile companies? Is it the driller of the oil, the refiner, or the gas station? These are tough issues. At the end of the day, what we did is we kind of accepted a compromise that was worked out by the members of the committee, and the editors really did a great job on this in negotiating wording. But at the end of the day, we basically said, look, the banks are working on this, and when they come up with a definition of scope 3 emissions, they should report it. And so you can find all the wording in the report. That's where it became a tough issue. But one of the nice things about the subcommittee was it was a risk committee. And we said, look, what is the risk that faces companies from their scope 3 emissions? And, the oil companies said, look, this is not, yes, the total emissions are a risk for all of us. but the scope 3 emissions that come from my company versus another oil company, those, no one's going to put those on me. So that's not a risk for the oil company. And so, you know, then when you come back to the banks or other financing companies, you raise this issue at the beginning, Anil. It's not clear that there is a financial risk from a bank making a loan to an oil company. So the bank may have a, and they do have targets for reducing their exposures to oil companies and so on. But that's really just the same credit risk that they would have for making risks to any companies. And so the question is there a specific risk to a particular company because of its scope 3 emissions? And that's something that's pretty hard to argue. So that's really where we got into the weeds a little bit and had to work hard to come up with compromises that everyone would agree to. But I must say it was very, it was a high bar in the following sense, that we were not only asking the members of the subcommittee to approve this report, but it actually went to the underlying organizations, their general counsels. And so getting agreement from the general counsels of all of these public corporations on regulatory, you know, complex regulatory issues was actually quite hard. But I think that because there was so much important, you know, progress in this report, in the end, everyone agreed with it. So I was very pleased with that.
Yeah, again, remarkable. I should have asked you if you had a coal company in there too. Did you have any coal companies?
No, we did not have a coal
so maybe
company.
Senator Manchin hasn't read this report, but I think we'll go on. So one of the things, Carolyn,
Anil,
yes,
Anil, could I very briefly come in?
yeah,
on this?
please.
So, I of course, I also think it's fantastic that you managed to get unanimity on the global carbon price. I think most economists would agree that this is the solution where we have to go. But I think what is extremely complicated is the political economy of that. Because, I mean, there is, of course, an intergenerational issue that probably some of the welfare costs that may arise are borne by the people who live today. And some of the benefits accrue to those who live tomorrow, right? Because they can still live on a planet that is I mean, worthy of living. And the question is how we can overcome that. And I mean, we all know that at some point we need to get to a kind of an optimal carbon price, but it's not easy to get there too quickly. And therefore also, I mean, this sharp rise in the ETS prices, for example, of course, that raises important issues. And as I said in the speech, especially if there are no ways to change behavior simply because the technologies are not yet there, and then the welfare costs are very high. And this is why, by the way, then the financial system is so important, because what we really need is a lot of new technology, and this has to be financed somehow. And this is where the financial sector comes in. So a functioning financial system that finances green technologies makes it easier to shift the carbon price up and to reduce the political opposition to that. But because I'm sure there will be a lot of political opposition. You already have a lot of that in the US, I guess, but also in Europe. I mean, as soon as prices get very high, I mean, that is highly controversial.
I totally agree. In fact, my next question was going to be on this political economy, more for Carolyn. So Bob showed that cross-sectional graph of where the relative price positions that all these countries start from. And you imagine you're sitting there in the Middle East, you've got all this oil in the ground. You certainly want to pump most of it out. And so one of the things that as I've learned more about this, I've come to realize is this idea that the price of oil is going to trend up and that's going to gently assist the transition seems doubtful, because if you were running one of these countries, you'd say, I'm going to get this stuff out of the ground while it's still got some value, which is going to keep the price low, which is going to exacerbate those things. And so I see two political economy questions that I'd like to get your thinking on. The first one is, as Isabel just said, the United States is a completely different place than all of the other major countries on these things. There was a report that Mark Carney and Janet Yellen chaired for the G30 that I'm guessing you've seen at least. And there was one chart in there that's been seared in my head, which was to show which countries were the farthest behind meeting their pledges towards net zero at 2050. And if you just look at the world's path towards that, essentially all of the shortfall is in the United States. So this is a G30 report that's aimed at the whole world. Most countries, there's a settled agreement in the direction of what all three of you have talked about, that this is a problem, we've got to do something about it. Better to use prices, better to get on a glide path. But in the United States, you've got no consensus whatsoever. You couldn't get 50 senators to agree that this is a problem. And so every year it's going to get worse in the United States. And I don't quite see how we unlock that. And then if you overlay that with the energy producing, the fossil fuel producers, I mean, they're not going to want to leave this stuff in the ground. So I don't see how we align the cross-country incentives. And what's the thinking on how we can get an international coalition to move in this direction? So let's start with Carolyn and then open to Isabel and Bob if you've got other thoughts on this. But those are, to me, two of the most intractable aspects of this.
So that's a really tough question because it's a tough problem. So, you know, for I would say a couple of things. That first is you're absolutely right. There are different incentives depending on whether you export this stuff. It's a big part of your economy. And so for a country like Canada, where oil and gas is a big part of the Canadian economy, it creates a lot of angst thinking about, and it's highly concentrated geographically as well. And so it creates a lot of angst about what that transition would look like. And it involves real people. So it's not just, you know, people denying the problem, and they're just saying, okay, well, if we have to manage this transition. And so for me, you know, a country like Canada who's agreed to the Paris Agreement and has started to take action, their intention is we may say, well, we don't know enough about the plan to have confidence that they're actually going to succeed. That's coming, all that, but they've, you know, I believe that they are committed. The governments in the country are committed to it. The thing is that needs to happen, which is partly happening in Canada, is a confidence that those economies can pivot to new areas of the economy that we created. And so if you think about the tasks or the knowledge base that's required for green technology, it's you know, the bioengineers and all that kind of stuff that are working on the oil field are actually really transferable to that kind of stuff. And in fact, you see a lot of that, the grassroots kind of growing in that area in provinces like Alberta, as well as elsewhere. And so if you think you know what you're going to substitute with, I think that helps politically, but it also helps with a reasonable plan. The thing is that I think is also going to be necessary, but is really hard, is that the financing that's needed can't just be green or brown. It can't have that split. It has to recognize, and I know it's difficult, the idea that these energy intensive and carbon intensive industries need transition funding to be able to lower their carbon footprint while there's still a need for those products. And in fact, for those products, there'll probably be a permanent need, just lower. And so that transition finance gap is really important. It's fraught with difficulty because there's what is really a real transition, what kind of government subsidies are aimed at that rather than just pumping up production. You know, those are technical issues that we need to tackle, but they're best tackled, I think, at the global level, and the G7 is a great place for that to happen because in many respects we're like-minded, at least these days. And I think the final thing is that if we want countries that are less wealthy and have more difficulty with the transition to make the transition, then rich countries are going to have are going to have to encourage them through transferring money and know-how. And I think it's just as simple as that, because otherwise it won't happen. It'll be too difficult.
Do you want to go ahead and add anything, either Bob or Isabel, to what she said about getting cooperation more in the United States from the deniers, and then also across countries, given the conflicting, at least short-term and medium-term incentives?
Yeah, well, I'll add, I'm not quite as pessimistic maybe as you are, Anil. First of all, as you saw in this subcommittee report, the business community, the finance community, the member, people who participate in the financial markets, they all understand that, we need to have incentives to reduce emissions. And again, as I mentioned earlier, that's kind of a tautology. We need appropriate incentives. You can't argue against that. And no one in the United States, I would say, well, we have one Republican, one party, the Republican Party, which is in disarray. And so, that's kind of unfortunate. It makes it tough to do anything. But as Senator Whitehouse, mentioned a few weeks ago, and he's been the leader in the U.S. Senate on this issue, we've got 49 Democratic senators who support climate policy. And so you're right to mention that there's one additional senator who is currently negotiating, who has already announced that he can support climate policy. And so I remain optimistic that we may get a strong climate policy with a lot of incentives out of this Congress. Now, if we don't, then next year we're going to have to go back and look for a bipartisan approach. But there are a number of Republican senators, Senator Murkowski from Alaska, Senator Romney from Utah, Senator Graham, and others who have said, we need a market-based approach. They understand that we need to price carbon. So actually, where I would say is we're very close. Everyone kind of gets it and knows where we're going, particularly in the business community. They're all committed to net zero by 2050, and they all understand that the only path to getting to net zero by 2050 is strong incentives to reduce emissions. So one of the other things that I think is very important to understand is that the financial community is forward-looking. So you look at, for example, the valuation of Tesla today, which the last time I looked was over $1.1 trillion, and bigger than the next 9 largest auto companies globally put together. So, we know where we're going. The valuations of the fossil fuel companies have really collapsed over the last 10 years. And now they're coming back this year, but from a very low base. So markets know where we're going. And really, the flow of capital in financial markets is driven by the hope to make profits, given the incentives that we have. And what's going on in the financial markets in the last couple of years is that everyone's expectations of the strength of incentives to reduce emissions and when those are going to be put in place has been going up dramatically. And frankly, in Europe, they're basically where they need to be. So, while there is and has been political opposition in Europe, Europe is basically there. It's the United States, which is really the blocking agent globally right now. I agree with that. And I think the United States is ready to move much more quickly than most people expect. Now, if that doesn't happen, and given the expectations that are already built into the financial system, I think, yeah, there could be significant problems. If I was a central banker, and I'm not, I would be more worried about the collapse of some of these, clean tech companies, their valuations, which are extremely rich and almost based on perfection of execution, rather than a collapse in fossil fuel assets.
Okay. Isabel, if you want to add anything, otherwise I've got a question for you. You want to come in on this at all?
Yeah, I mean, I could say 2 sentences and then you ask your question. Okay. So just I think Bob made an important point that of course we need incentives for the transition, and even if there's not yet a carbon price in the US, I would think that, the US in many areas were a technology leader, and they, much of the innovation that's going to come is going to be related to the green transition. And I wonder whether the US economy really wants to lose out on that. And I don't know, I would be surprised somehow. So I have some hope. For Europe, one of the problems is, of course, that, if the carbon price is so much higher in Europe than everywhere else, then there is this issue of firms relocating to other places, and therefore we, of course, now have this discussion about protective measures, such as a carbon border adjustment tax, which then, of course, would affect everybody, including the US, who wants to export to Europe. So that was a bit more than 2 sentences. Sorry.
Well, no problem. We've got time. I'm going to ask everybody a question. I'll give you a minute to think about that, and I'll ask in the interim Isabel something to that's more specific to her thing. The question for all of you that will come second is, what are the 2 or 3 best ideas that you see globally that are best practices that if we could just get that stuff dispersed? And I don't mean just putting a price on carbon, but other things that maybe ease some of the pain or recompensate some of the losers or others that are going to be tough in the transition that people have figured out but haven't been widely adopted. I think that would be something interesting to hear perspectives on. While you're thinking about that, Isabel, one thing that you said that struck me was this the upside risk to inflation that was coming from the current pressure from energy, and how on average going all the way down to zero was unlikely. Let's suppose that inflation does remain high and the ECB is challenged on that. One of the other things that you've talked a lot about, and that Christine Lagarde has talked a lot about, is just whether or not there should be some form of green quantitative easing. And kind of one thing that you hear debated amongst central bankers is, how far can the mandate stretch, and what are the boundaries of all of this? And is there a risk that if the inflation remains elevated, some of these other things that I guess you guys think are important are going to have to be dialed back as well? So is this kind of correlated risk that if you miss on the central objective on inflation, that it actually will be super negative because of all the other things that you'll have to step back from? So I'm curious. I know you've spoken about this, but maybe not everybody here has heard this before. So I wonder if you could share that.
Yeah, that's of course an excellent question. As you know, last year we published the results from our monetary policy strategy review, and actually climate change was one of the issues that we thought very carefully about. And we published what we called a climate action plan, which touched upon many different areas. So starting with economic modeling, with data, which many of the others also mentioned, which is of course very important. But then we also talked about monetary policy operations. And you mentioned the greening of QE. There's of course more than that. I mean, there are questions about the collateral framework, about disclosures and so on. But then indeed, the question comes up, what happens if there is a conflict of objectives, let's say, right? And then, of course, and I actually gave a speech on that, which was called From Green Neglect to Green Dominance, ? And of course, given that our primary objective is price stability, it is perfectly clear that this is the objective that has to take precedence. So it would not be possible to say, so let's say we shift it entirely, which is nothing that's going to happen anytime soon, but we shift it entirely to green assets in our QE program. And then we could not say, well, inflation is high, but we still need we still think that climate change is so important that we cannot scale back asset purchases. So that cannot happen. But let me say that given where we are, there are of course ways to deal with such a conflict. So, for example, I mean, now the asset portfolio that we are holding has a relatively strong bias in the direction of carbon-intensive industries. And so let's say we need to scale back asset purchases, and then also at some point we reduce our balance sheet. Of course, we could still think about changing the stock that we have, right? Because the stock is still has this full carbon bias, and so we could. I mean, we haven't discussed any of that, but I think that would be one natural way to deal with that. That maybe in scaling back, we would scale back more on the less green part than on the green part. I think that would be perfectly consistent with our strategy, and would kind of resolve this conflict a bit. But this is a conflict that is there, and actually also my speech today is precisely on that conflict, because if from the transition there is a threat to price stability, I think we cannot simply say that that other objectives are so important that we can give up on price stability. So that will not work, and that would not be in line with our mandate.
Okay, but just a follow-up question. All three of you at various points in your presentations said something about data. I just wonder if you've got, and there are many aspects to the data, the disclosure, all this stuff, but how about just thoughts on greenwashing generally? So one thing I've always wondered about is, if you ask 5 ESG managers who's green and who's not, and then whose bonds the ECB is willing to buy, or how do we do stress tests around all this stuff, there's still quite a bit of disagreement amongst people in the private sector about how to do this. I wonder if you've got thoughts on anything about that aspect of the data that we could share with the audience, and then we'll come to the question about best practices, and then we'll open up. And just for the three of you, I'm assuming you can open the Q&A and you'll see the questions that are in there, and that's how we'll go through the ones that are there. But first on greenwashing, any wisdom about how that's likely to unfold and what we're going to be able to do to manage it?
Well, yeah, I'll jump in here. I would say, again, as in many things related to climate, the Europeans are ahead of the United States in terms of, for example, defining terms. And what we are seeing now, and maybe I should have said this earlier, is that we're seeing the US regulators really following up on basically all of the recommendations that we had in that CFTC report. And some of those recommendations were that we do need to define terms in this country. We won't have a taxonomy exactly like the Europeans, but they are way ahead of us. And we do have to define things like, what does it mean if you have a green bond? Or if you say, I've got a sustainable investment fund, what does that mean? And you are seeing now the SEC in particular asking very direct questions about, are you making claims, and can you support those claims? And particularly with respect to the private sector, as it starts to disclose climate-related risks, there is a huge need for data and analytics. And one of the areas where I wear a hat is as an advisor to something called OS Climate, which is an open source platform that's trying to put together public data and analytics for addressing climate-related risks. And there's a lot of support for that, and we're moving forward very quickly because there is a lot of public data, non-proprietary data that can be shared, and a lot of approaches to doing things like measuring the climate, or let's call it the alignment of an investment portfolio with net zero, or measuring the alignment of the targets that a company has with its actual outcomes. And so there's an awful lot of focus on disclosure by private corporations about understanding the climate risks in investment portfolios. But there's a long way to go, certainly, in terms of understanding that data, particularly, I would say, on the physical risk side, because that requires so much local information about where things are located, the hazards that they are exposed to, and the mitigation and adaptation that corporations are planning over the 30 or 40 or 50-year horizon that these physical risks will be increasing over.
Okay. Carolyn, Isabel, if you have anything more to say, otherwise we'll go to my last question, then we'll turn to the Q&A. Okay, so
Yeah,
let's.
I would
Go ahead.
actually like to come in. So, I mean, there, as you probably know, there is currently an active debate ongoing in Europe about our taxonomy. And I think this debate shows very clearly why it's so complicated. So, you know, there is this discussion on whether nuclear energy should be included in the taxonomy as green. And as you can imagine, this is a highly controversial topic. And so you have to ask the question, I mean, of course, in carbon terms, nuclear is fine, but maybe in other terms, it's not. And this shows how difficult it is. The other issue is gas. So as I also mentioned in the speech, gas is very important in the transition phase. So what should we do? Should we accept it at least for a transition phase or not? So the question is, can we really even say that certain activities are green or not green, but just looking at them themselves, or do we have to, I think, a difficulty that we are facing?
Yeah, the general equilibrium on all of this is a mess, and there's lots of multiple equilibria too, where you want to rule out the worst options. All right, so I'm curious if you can each think of something that you see one country or a small set of countries doing that look like best practice that, if widely adopted, would be not maybe a free lunch, but closer to one where we're just kind of leaving benefits on the table by thinking narrowly and not kind of doing a broad enough based assessment. So if you've got anything like that, let's share it, and maybe we can launch this into the public domain and get some momentum going on that. And then we'll open up Q&A and look for questions that have been posted there. So I don't know who wants to. Carolyn, you want to go first?
Sure. Actually, I just wanted to leap onto the last question really quickly,
Okay.
because, you know, what Isabel said linked back to a point that I made earlier about transition financing. And I think that when you look at what are the inputs actually to achieve to achieve some of our objectives in terms of lowering our carbon footprint, the inputs in the supply chain actually might be highly carbon intensive. And so, getting outside of the oil and gas, you just think about rare earth minerals or any of the mining products that are inputs to high performance batteries in electric vehicles. And so not only do we have to think about carbon in its totality, we have to think about whether all carbon emissions are created equal from a transition point of view, because if those carbon emissions are contributing to net lower carbon emissions, they should be thought of differently. And the cost to investors in that technology needs to reflect that. So I think it's a very gnarly issue, but it's one that I think we need to tackle if we're going to succeed. And also, I think we need to recognize the role of governments. There's a lot of externalities and coordination problems that mean that governments are going to have to cough up to help this investment forward in one way or another, through policy, through actual subsidy of these investments. And so it's not all about, I don't think green financing can do it all, even if it were perfectly defined. So on the best practices, I would love to have an actual example, but I wanted to plug an idea that we had in our G7 report, if that's okay, because I think then it would be a really important thing. You know, your question is about easing the transition, especially, and for me, the best ideas to ease the transition are the ones that lower the cost of the transition in the first place. And so, and that means investment. It always has to start there. And given the scope of the investment that's required, even say we've got some new, existing technology, we need new technologies. And I think that means, at least at the G7 level, that we need to band together. And there is a precedent for this that we kind of hung our hat on, which was a European organization for nuclear research that was actually put together in the 1950s, and it was highly successful. It was called CERN. And so what we thought is that the G7 should champion kind of a climate-related CERN to share technology, develop technology, and help make those kind of mission-oriented leaps that we think need to be made to advance our abilities faster and achieve our climate objectives in a less painful way. So that would be my idea. Anything that makes investment better and more of it.
Okay, great. Isabel, Bob, I don't know if you've got pet examples that you can wheel out. If you do, now's the time. Otherwise, we'll transition.
Well, I'll just make two quick comments. First of all, I think that the border carbon adjustments that Isabel talked about, and which now the US has joined in negotiating with Europe, will provide, can and should provide the incentives for, countries that haven't yet priced emissions to move quickly. It creates the opportunities for this global harmonization of pricing that we talked about. And then the second thing, which I am very excited about, is the development of a forest carbon credit market that can actually incentivize the direct capture through natural carbon solutions. And in the last COP, we did get agreement finally on Article 6, which provides for the jurisdictional oversight of this process. And I think the opportunities for remote sensing to actually measure carbon flux on landscapes globally will allow for the rapid development of real carbon credits that can be used in compliance markets. And that then, if it develops in the next couple of years, will be a globally harmonized carbon market. So I'm excited about those opportunities as well.
All right, that's great. Isabel, do you want to add anything?
Yes. So first of all, the points raised by the others are excellent. I would like to add one point to what Carolyn said on the need for investment. Of course, everybody agrees to that. So from a European perspective, what would be really important is to strengthen equity type financing, because it's you know, that is still not as common as it is in the US, for example. And for the type of technologies that we need, equity type financing would be much better suited than debt type of financing. So for Europe, there we could learn from the US, which could help our innovation in that area. But the point I really wanted to make is the one that was already mentioned before. Namely, I believe the political economy issue is the most important or most difficult one. And therefore, I think what we need is a compensation of those who are hit the hardest, but not in terms, of course, we cannot compensate those who consume the most carbon the most, but I'm talking about those who are least well off and who are hit disproportionately hard. So we need to find proper compensation mechanisms that do not remove the incentives to economize on carbon. And I do think we have, some countries have things like that already. The European Union is also working on that, but I think that is absolutely key.
That's great. And you showed that data from Spain in that paper, which provides some tangible examples of that. Okay, I'll ask you each to open up the Q&A. You'll see that there are now 7 questions in there. I'm happy to let any of you pick any of them if you want me to try to assign them, but maybe you can just look at the questions, and then if you want to jump in, just go ahead and unmute and come in. Does anybody see?
Anil, there's one question that I'm happy to jump in on, which is one about property casualty insurers, and aren't they collecting data on this? And the answer is, yeah, they've been ahead of this curve for decades, and understand the increasing risks, for instance, from sea level rise and stronger hurricanes, from wildfires and so on. But the real question is, what does government policy do about this? This is, many people think, well, the insurers are going to be go out of business, but in fact, the insurers only write policies for 1 or 2 years ahead. They don't,
Right.
this is actually a business opportunity for the insurers. But the real issue is, what do we as a society do about the fact that, there are just bigger risks, and and there's going to be more damage. And so we need to get the incentives right, for instance, for people to move out of flood zones rather than to subsidize the insurance in flood zones. And in my home state of California, there's been a recent recognition over the last few years that wildfire risks are going to be much higher in the future than they are to date. So are we going to force people to move out of those exposed areas into hardened cities, which is frankly the right thing to do in the long run? Or are we going to try and subsidize people who are currently living in those riskier areas? In which case the total cost to society obviously becomes much higher. So I hope it's the former. It's sad. It's sad that these risks are going to be there, but we have to recognize them. And it's not something that's going to put the insurance companies out of business. They're very aware of what these risks are. And the question is, will governments allow them to raise the rates to reflect those higher risks?
Okay, let me take some of these off the table because I think you've already answered them. So the question about disclosure, you've already talked about the fact that we've already seen that there's got to be a taxonomy, and that we're moving in that direction. And question is, what's material? What about the differences in prices there? We talked about the border adjustment tax and how that might be a way to kind of internalize those differences and create better aligned incentives. So let's consider those done. Question of whether climate risk has an identifiable effect on financial risk. I think also we've covered that. The fact that there's going to be these transition costs, you've got stranded assets, that's a risk. Bob just made another good point about that, about how the horizons vary. One of the things that I think most people don't realize is, the simple thing would say, well, banks can keep lending as long as it's going to be the case that they can keep stuff insured. But of course, almost all the insurance contracts are very, very short term. So just because you've got a 20-year loan to somebody to build a plant that's on a floodplain, at some point the insurance can just go away and the loan isn't. And so there's real risk there. That's part of why the scenario analysis that Carolyn talked about is so important, to force them to look far enough ahead and not just duck the question essentially by saying, well, we're going to pass the buck to somebody else. So I think that's important. Let's see. Okay, here's one from Bill English that I think is quite interesting, that at least Isabel and Carolyn would have thought about. Do you think it would be advantageous to put, probably as a secondary objective, something about climate specifically in the mandates of the central bank? I know the ECB has kind of interpreted that as like, and in some countries you'll say the secondary objective is to support government policy broadly. But A, do you think that would be important? And B, is the political economy of such that you think you could get that done in a way that would not cause more trouble than it's worth? I mean, I don't think it's an accident that the Fed, for instance, joined this network once Trump was off the stage. So thoughts on changing central bank mandates, or do you think it's already close enough? You've got a way to do it.
So I can take that question. So because we've discussed that, of course, a lot. And so I would say that the ECB's mandate is actually broad enough. So, I mean, there are several ways through which climate change can enter. And one, of course, is through our primary mandate of price stability, because it does affect price stability in many ways. I mean, through monetary policy transmission, because it affects the banking sector quite dramatically, potentially. I mean, it may affect our star. So, I mean, even within the primary mandate, there are already many reasons why central banks should have a look at climate change. And then, as you mentioned, the ECB has a secondary mandate, which is to support the general economic policies of the EU. And in the treaty, environmental issues are explicitly mentioned. And therefore, basically, under our secondary mandate, we already have an obligation to deal with this, but only without prejudice to our primary objective of price stability. And I would say that that is actually sufficient.
Yeah, I would say that my read of the Bank of Canada and the Bank of England's mandate, so that they're broad enough to cover a role in climate change that's related directly to their mandate, whether it's monetary policy, financial regulation, or financial stability. And in fact, I view kind of putting climate risks directly into the mandate to be potentially very troublesome in the sense that outside what's already part of the mandate, it makes you wonder what's the tool and what's the actual objective of that is distinct and different from what is the government's responsibility. And particularly the danger there is just mission creep in a sense, especially given the crisis where central banks were called on to solve a lot of problems that they never expected they'd ever have to solve. And in fact, there's been a concerted effort to kind of make it really clear what the mandate of a central bank is, what are their tools, and how can they achieve it. And if you just think about the investment policies in any of the asset purchase programs, if the objective of those programs is squarely to stabilize the economy and get inflation back to target, especially in some economies like Canada, where the available assets are highly concentrated in high emission sectors, you couldn't possibly achieve your primary mandate objective while at the same time implementing some kind of industrial policy aimed at climate change. And I think second to that, to the extent that the definitions and rules about what's green and what's not are highly contentious and to some extent subjective, for unelected officials to kind of wade into that in their own investment plans would be problematic for obvious political reasons, and I think obvious governance reasons. And so I think it's actually a good thing that the central banks now have the mandates that they do, that allows us to make a meaningful contribution, but in our lane.
Goldilocks, just the right amount, right? Bob, I don't know if you want to come in on that, Bob, otherwise we can.
Well, just quickly, the CFTC subcommittee did look at this, and we felt that we didn't need to change the mandates for the central banks or the other financial regulators. In the US, under the Dodd-Frank legislation, the Financial Stability Oversight Council has responsibility for emerging risks to the financial system. This is clearly an emerging risk, and the Financial Stability Oversight Council is clearly taking it on. And so the Fed has a role, but it doesn't need a change in its mandate.
Yeah, let's hope the FSOC gets off the couch and does step up. Hopeful of that. We've got time for a couple more questions. One is the question about is carbon, what comes next after carbon? So there's obviously many other environmental threats, maybe not so directly related to climate change, but still long run harmful to the planet. Where's the thinking on that part of things? And is there a priority after getting carbon pricing? Yeah.
Well, I'll jump in and say yes. Carbon is just one example of what might be more broadly viewed in sustainability terms. We have to be sustainable, and there's ecosystem services that are provided by nature. of which pulling carbon dioxide out of the atmosphere is just one small piece of that. I think this really comes together when we talk about these natural climate solutions, that, you know, we don't want to be planting eucalyptus forests in order to pull carbon out of the atmosphere. We want to protect all of the ecosystem services that are provided by nature. And so we have to look at biodiversity and clean water and, you know, the indigenous peoples that live on many of these landscapes and their livelihoods. So bringing the conservation community together with the investment community in generating these carbon credits is going to be a difficult task that has to look well beyond just carbon per se.
Okay. Carolyn, were you trying to come in, or if not?
I was going to say a lot of what Bob just said. Maybe what I could add is to say that clearly, aside from creating the markets that promote kind of a recycle and reuse, there is a role for standards, and ideally international standards that would improve market circularity, particularly for areas where the recycle and reuse rates are very, very low. And so I think that's another avenue to explore.
Okay, we're coming to the end of your time. I'm going to give you each, you know, say 30 seconds to a minute. If there's something that I didn't ask, or that you want to get out there that we haven't covered, now's your chance, and then we'll wrap up. Let's start with Isabel. Is there anything more that you think we should leave on the record here?
Yes, so actually I would like to repeat a point that Carolyn made, because I think it's extremely important. And this is the point that what we really need is transition funding. So it's not enough to just say this is green and this is not green. But what we really have to do is that we have to ask ourselves, how do we get, how do we manage to get the industries that are now not green, how do we make them green? And this is really, I think, a taxonomy, let's say a static taxonomy cannot really do the job. And we have to think about how basically particular also financial products can be developed, which help to kind of fund the transition. And I think this is really the key part, because in these areas that are already green, we cannot do much more. But where, these areas that are not green at all, we can do a lot. And this is where the change has to happen. And therefore, I think this is the big challenge. And we cannot just say we exclude all of that from funding, because that will not help us. But we have to find ways to manage the transition. And that's, I think, is a key issue in the financial sector. Great point. Carolyn?
Well, I'll just build on that, because I think that one of the barriers is the fear that it's greenwashing. On the other hand, I think another barrier is what are the real benefits from doing that? Do we need that, or shouldn't we just go to zero immediately? And I thought that, Isabel, your to zero use of fossil fuels, like we should just be in that camp where we stop using them, as opposed to financing this transition. It's just prolonging the agony. I think that your presentation gives one really compelling reason to manage the transition, because if there's still a demand for these products because the other stuff's not ready yet, it's going to present the central bank and governments with really difficult public policy choices, and in particular inflation or growth. And that's just a really bad place to be. And if it's avoidable because you have managed the transition and reduced the carbon footprint of these high emitting sectors that are going to be needed for a while, then you reduce the risk of being backed into a corner. The way you presented, I thought that was very powerful.
Thanks. Okay, so Bob, you get the last word here, a minute.
Well, all I'll say is I'll just underscore that the pricing, I think, of emissions globally is much sooner coming and than people expect. And as was discussed earlier, Europe is really already just about there. It's the US and China, which are really the actors now. And I'm hopeful that they will break this logjam within the next couple of years, and that we'll get to the level of pricing that we have in Europe, at which point I think it's just off to the races. That pricing will reduce the uncertainty about when things are going to happen. That will unleash the flow of capital that's already starting in anticipation of that. So I'm very optimistic that things are going to start moving much faster in the next few years than they have been. And hopefully technology will develop that will help us get ahead of this crisis.
Thanks. And I mean, I guess it's one piece of good news is the fact that despite all the tension between China and the US, they're at least getting along in the climate space, which is great. This has been a fantastic discussion. I won't even try to summarize it, but thank you all so much for giving us your time and for allowing us to record this session. It'll be up for, I don't know, 6 weeks more for people to refer to. And thanks again. Enjoy the rest of the day and enjoy the rest of the conference. Bye-bye.
Thank you.
Right, thank you.
Thank you so much.